Hari Shyamsunder, VP Institutional Portfolio Manager with Franklin Templeton Emerging Market Equities. Good morning. Thank you for joining us. Let's start with the very basic question. What is your view on the market based on earnings, valuations, and macros?
Good morning, Nikunj. It's good to be here. So over the last 45 days or so, we've gone through a lot of noise in the markets, and some of that noise is definitely settling down now. Whether it's on the tariff front or well on the border as well, we have seen a lot of noise around some of the news coming out of there. But now that some of that dust is settling down, it's back to looking at the numbers which are coming out. The Indian markets have been in a correction since September of last year, and some of the reasons why the correction started have not yet been fully addressed. Whether it is a slowdown in the economic momentum, or whether it is the earnings being cut pretty sharply last year for FY25 in particular, some of those still are being fleshed out. So I think that's where we are. We are back to looking and focusing intensively on the numbers which are coming out, particularly the quarterly numbers, and we're looking for the trends coming out of the end of FY25 and trying to get some signals as to what that means for the next year as well.
Okay. In the light of where the global macros are headed, which is that interest rates are unlikely to come down in a hurry, tariff, whether it is 15 or 20, tariffs have kicked in, which will have an impact on the way how inflation would move. There is definitely a huge disadvantage for India because of China. So connect all the global macros for us and what it means for valuations.
Sure. I think whichever you cut it, it looks like some of the impact of the tariff wars is going to be negative at the margin at least. So it has led to certain slowdown in whether it's on the investment side. It led to certain pickup in consumption in terms of front ending of consumption, at least in the US markets for sure. But what this has just meant is that the overall uncertainty and the price increases are not good for consumption on the US markets. In addition, what we have seen is that generally all-round uncertainty has not fared well for the overall markets. But if you look past some of these, then I think Indian markets do tend to stand to gain in some parts at least. We have seen, some news on the electronic side, on the mobile phone side of companies looking to shift some of the supply chains to India. I'll take some cues from there and get a bit more positive on some of the opportunities which could emerge as a result of some of the global turmoil which is happening. India has not been really too great on manufacturing in terms of percentage of GDP at least. We have lagged our neighbors and some of the other emerging markets. This could be a good time for us to cover up some of that gap at least.
Good morning, Mr. Shyamsunder. This is Shrishti also joining in. Help us understand what you make of the earnings for this particular quarter, because for now we haven't seen much of a disappointment kicking in, but the investors are not building much hopes for the first half of the next fiscal. Help us with some understanding on this one. How are you looking at that and what's your expectation?
Hi, Shrishti. So the way we're looking at it is that we need to look at the trends and how this has been shaping out over the last few quarters. Post Q2, we saw a sharp cut in the earnings for the markets. And if you look at the kind of beats to downgrades, really, what we have seen is that now at least the beats to misses at least has been a bit more stable in this quarter. That's really the best I can speak about this quarter. But what we have also seen is that the upgrades to downgrades are still not looking really favorable. What that means is that for next year, the earnings continue to be cut. FY26 earnings are continuing to be cut. So in FY25, we saw a sharp cut. We were expecting at the start of the year about 15% growth. That's landing up in maybe the high single digits. Now, going into FY26, we have started off with that kind of an expectation again. And at least heading into it at the start, we are front-ending the cuts, which means that, as long as the earnings are continuing to be cut and pretty sharply in some cases, what that means is that it could serve as a lid for the markets.
What is the risk for this market? Is it valuations or something else?
Well, I think it continues to be the earnings. I mean, the earnings momentum has not really picked up. Well, we can say that the economic momentum has bottomed out. We have seen enough signs of that in the Q3 numbers, and I think the Q4 will also continue to affirm that that expectation that the economy at least is bottoming out. But on the earnings side, what we are seeing is that, well, it has bottomed out, but the economic momentum isn't as strong as we would like to see it. Across the sectors, if you look at it, we are getting into a market which is very bottom up. We are finding ideas in sectors, but broad themes are a bit harder to come by. It's really getting down to stock selection in each of the sectors.
Okay. What is cheap in this market? What is expensive? And where is value in this market?
And that's a great question. And unfortunately, the answer is going to be very selective because we can go across sector by sector, and it's hard to find broad sectors which are very cheap. One part which we do think still offers relative value continues to be the private banks. And that is one place where we are positive and overweight on. The other places, what we have been looking at is doing a bit of growth adjustment on the longer term. So whether it's something like a consumer services, there we have been adopting an approach of looking at where there's a bit of temporary disappointment on the numbers, and those are the kind of opportunities which we are then looking to lap up, because over the longer term we're pretty clear that the Indian consumer is changing its habits. It's moving more towards consumer services, more towards consumer discretionaries, and what that means is that that offers up opportunity if you look past the near-term, short-term disappointment. So it's really about identifying growth in this market where you're more confident about shifting growth patterns rather than maybe just looking to hunker down purely into value.
Okay. Let's start talking about sectors then. One sector where right now the jury is not out whether it is cheap or whether it is a realistic view, which is IT. I can argue about these are fantastic companies, they do buybacks, cash, and stocks are cheap. You can argue back and say that by growth kahan hai? AI, US, maturity of business. I don't know which side of the argument would win. So let's start arguing.
So on the IT side, I think we are mostly neutral. We are a bit mixed on that. And the reason we are mostly neutral is we see both sides of that argument, really. So, I think on the large cap IT, if you look at the size of our IT companies now, the IT exports from India are close to about 20% of global IT spends now. In terms of headcounts, we are about 35 to 40%. So we are not small by any stretch of imagination. Over the last 20 years, it's gone from 4% to 20%, 4 to 12 to 20%. So now, if you say, quote, maybe 28% even in the next 10 years, then the rate of growth definitely has been slowing down. So we need to keep that in mind. At the same time, we have seen headwinds coming from the GCC side, where the global capability centers have been ramping up in India. And that has acted as a bit of a headwind for the IT companies as well. And at the same time, put into all this mix, we have seen that AI is now, it's a bit of a wild card in terms of what kind of impact there can be. The impact we can see immediately, the kind of benefits, the kind of new use cases that can come up are a bit harder to envision. So it's a bit of waiting for some of those to become a bit clearer while we can immediately see some of the impacts which are coming through.
Right. So Hari, start of the year, one was pretty. It was pretty apparent that all and everyone just wanted to stick it out with the large caps because the whole valuation bubble, so to speak, started off with small and mid caps, right? Data in the April recovery doesn't seem to be suggesting so. In fact, if nothing, mid and small caps at an index level have done a lot better. And I'm not even talking about individual stocks here. Do you think it makes sense to do any kind of market cap categorization or classification in your portfolios?
So on the debate between large, mid, and small caps, we have been acknowledging that large caps had become cheaper. At least the most recent rally has taken it up now, maybe to 1 standard deviation above long-term averages again. But what we would note is that over the next 3 to 5 years, we continue to believe that given the drivers of the economic growth in India, just the texture of that would tend to benefit mid and small cap earnings over this period. So while mid and small caps might be expensive and they are continuing to be above the long-term averages, we note that we can't exclude them completely. If you're going to look at Indian growth story, if you're going to look at the Indian opportunities which are coming out, then the mid and small cap need to continue to be a part of the portfolios. So we have not moved into a camp that's just completely throws out the mid and small caps and says that that's completely uninvestable. Instead, we continue to look for opportunities. As I said, looking particularly where maybe valuations have become cheaper for some of the maybe not sound reasons in the long term. Maybe there's some short-term reasons why the stocks have corrected, and we are looking to pick them up.
So I'm going to change gears and talk about something which you said, manufacturing. India is not big in manufacturing, but manufacturing stocks in India have done well. Whether India does well or not, I don't know. Manufacturing stocks have done well. Defense stocks have done well. Power stocks have done well. Solar power stocks have done well. There is a lot of narrative in the market, right? जिसे हम कहते हैं ना storytelling stocks. What happens to some of these storytelling stocks? Manufacturing, defense, solar, EV, yeah, another
drones.
One. Drones, yeah, new one. Thank you, drones,
that?
yeah.
That's the new one.
Yeah, so that's really the big debate, or it's a big challenge because the valuations are not cheap by any stretch of imagination. So it is something which we have been struggling with as well. The opportunity is kind of clear in some cases. It's some of it is, as you said, there's a bit of a story, of course, a narrative which is being built, and the numbers are not yet as clear. So in these cases, again, we have been looking for better levels, and while they were approaching better levels, I think before we could act on them decisively enough, maybe the stocks have moved up very sharply. But I think manufacturing, we don't need to look at it directly in terms of some of the sectors which have been mentioned. But there are still continuing to be, industrial product companies, for example, where we still own certain positions. There are certain, ancillary associated with manufacturing kind of stocks, which we can look at instead of looking directly at some of the headline names. But you're right. I think the challenge here is that valuations have become pretty stretched here, and so we need to get a lot more conviction on the visibility of the numbers before we wade into them with a lot more conviction.
So what should be the expected rate on return? We've done 20 minutes of sector valuations. Ultimately, it matters is that for a viewer, he wants to know from you that if the starting point is today and the time horizon is 3 years, will a large, well-managed, equity diversified scheme, will it first beat the index? And what could be the index return?
As I said, this is a market which is going to favor stock picking. So we like our chances here in this kind of a market where it's down to the skills of the fund manager in terms of picking the stocks. So over this period, I think as a market, we should still be looking at the range of about, let's say about 10 to 13% for the large caps at least, and mid and small caps, given where we're starting off from. The market should land up across the board. Broader markets itself should be in this kind of a range, compounding at 10 to 13% over the next 3 to 5 years. So I think that's the kind of expectation which we should awaken given where the valuations are today. Within this, of course, I think there are a lot of new stocks which are coming up. We just note that over the last couple of years, we've seen a lot of stocks being listed, about 150 odd in the main board at least. The Indian stock markets are very dynamic. There are a lot of new ideas coming. While we don't participate in all of the IPOs, they are a pool of ideas which we keep coming back to. And I think that's what keeps the Indian market interesting.
Yep, interesting times. Hari, so good having you on the show today. Thanks for your time.
Thank you.
If you like this video, then like, share and subscribe to ET Now.